NIO is an electric vehicle manufacturer with a unique twist. Instead of plugging your car to charge, you can pull up to a power station and change your battery for a fully charged one in less than 5 minutes. Cool, unique technology combined with high-end, beautifully designed cars make for a good growth story, resulting in NIO's stock being one of the most researched stocks on the market. Do the swappable battery technology and NIO's premium brand give the company an edge over other EV makers? Some investors certainly believe so, and go to the extent of calling NIO the next Tesla. Is NIO truly the next Tesla? Let's talk about that. I am Hoda Mehr, founder and CEO of StockCard, and on this channel, I share detailed fundamental analysis and interesting investment stories. The last time I looked at NIO was 4 years ago, when the company was about to run out of cash. I am surprised to see it is still around. Manufacturing cars is hard and capital intensive, and NIO isn't the only EV maker in its core market in China. The fact that the company is still around makes me wonder whether there is more to NIO's story than meets the eye. The market seems quite excited about NIO recently, since the price is up by more than 30% in the last month, after hitting a 52-week low of $7 per share due to a gloomy quarterly earnings report released a few months ago. Perhaps just like Tesla, which was once running out of cash, NIO has found its way through challenges and is becoming the next Tesla. The company has a $15 billion market cap with $7 billion in revenue in the last fiscal year. It makes most of its revenue from selling new cars in China, and additional revenue comes from services, financing, and second-hand car sales. While the company is focused on the Chinese market, it has also presence in a few European countries, such as Norway and Germany. It is currently priced at about 2.5 times its sales, which compared to other EV stocks such as Tesla at more than 11 times price to sales, the stock seems quite undervalued. We need to know why and whether it's an opportunity to buy now. Typically, if you've been with me, I follow a 6-part fundamental analysis to decide whether I'd be investing in a company or not. Today, I'll change the flow and give you a quick recap of NIO's 6-part fundamentals at the beginning, and then spend more time on a qualitative assessment of the company. That's because, as you will see in a few minutes, if I just use a fundamental analysis of the company's financial information, NIO won't make the cut. Sometimes when you invest in a growth company and want to find the next Tesla, it is worth taking risk for a shot at gaining a significant return. In those cases, in addition to analyzing a company's financial information, you look for early signs of growth despite the struggling financials. Before investing in such early stage companies, I typically look at 5 important growth criteria. Does the company operate in a growing market? Are there signs of customer traction that can lead to rapid revenue growth down the road? Does the company have access to lots of cash, or can it raise additional capital? Does the company have a competitive moat, such as unique technology, brand, market access, or some sort of monopoly over the customers and the market, among other factors that enable it to grow despite struggling fundamentals? And lastly, is it run by a unique and capable management team? So today's question isn't whether NIO is financially solid. It's whether NEO is investable despite apparent financial risks in its fundamentals. Let's see why. When I pull up the company's stock card, I see a stock struggling financially. Let's recap NEO's fundamental analysis. Its revenue has been growing slowly year over year, although quarterly revenue is declining due to recent vehicle price cuts. It makes no profit, and more importantly, its gross margin has drastically declined to only 1.5% from 15% a year ago due to lower average sales price and higher battery costs. The company has its eyes on 20,000 car deliveries per month, but in June 2023, it has delivered about 10,000 units, roughly the same as the average monthly deliveries in the last 12 months. The deliveries have recently taken a hit as the company launched a new lineup of vehicles and needed time to ramp up production facilities. The management believes the gross margin will return to the 15% range in Q4 2023, and the company will become profitable, which is something to hope for and watch for. Its balance sheet, at best, is in an okay situation, with the same amount of cash and current debt, forcing the company to reduce its R&D projects and capex investments to maintain cash in recent months. It makes no free cash flow to replenish its cash position and most likely would need to raise more capital in the coming years. In summary, the company has struggling fundamentals with good targets in the second half of 2023 and beyond. If it manages to reach some of its targets regarding deliveries, revenue from new vehicle lineups, and profitability, it will be in a much better fundamental position. However, looking at the current fundamentals we just discussed, it becomes easy to understand why the stock is priced only at 2.5 times sales. The market sees the same red alerts as we do. If we are interested in investing in NEO purely based on fundamentals, we have to wait and see how it implements its plans in the next few quarters. Now, as we discussed at the beginning, let's explore the qualitative factors that may still justify NEO as an investment now. Like all companies, NEO benefits from a rapidly growing market and a shift in consumer preferences towards EVs over combustion engine vehicles. For example, in NEO's core market in China, the EV sector is expected to grow by 25% per year, which results in organic growth. This is most likely the primary reason NEO hasn't run out of cash in business, despite its struggles and cash availability challenges in the past. There is a lot of excitement around EVs globally, and many large investors are willing to fund EV manufacturers, not too dissimilar to Tesla's early days. As we discussed, the company makes EVs with swappable battery packs. Instead of waiting to charge your battery, you can enter a power swap station and swap your car's battery with a fully charged battery very quickly and be on your way. There are currently about 1,500 power swap stations worldwide. Considering reasons to invest in NEO despite its alarming financial struggles, the swappable battery pack and stations is a unique technology that can give the company an edge over other EVs. With the new generation of power swaps, it costs NEO between $500,000 to $250,000 to build new stations and more money to run each station every year, and it can charge a little bit more than 300 cars per day. This means to scale, NIO still needs lots of cash to run and build those stations. Mind you, Tesla also had a swappable battery plan with one station in California, but the company focused on expanding its charging stations due to a significant investment required to build and run power swap stations. It makes you wonder if the technology is available to other EV makers, then it isn't as unique or economically viable as we hoped for NIO. NIO cars can still be charged in a charging station. NIO still needs to make chargers and charging stations available and invest in its swap stations. Double the capex investment, double the hassle. We know NIO isn't profitable, and with all the capital expenditures required to build its power station and charging network and ramping up sales and marketing for its new car models, there is certainly a limited expectation of profitability or free cash flow in the near future, despite the management's plan. So I, for one, seriously waiting to see if the profitability plans pan out. If sales and deliveries do not ramp up as fast as we hope, does the company have enough cash to continue investing in its growth? Probably not. There's some good news related to this balance sheet though. Only a few days ago, the company announced a $738 million investment by an investment company majority owned by the Abu Dhabi government. The Abu Dhabi government investment also comes with a board seat, giving the investment company a 7% ownership in NIO. So the investment can add some cash to NIO's balance sheet, but it is more of a strategic investment that potentially opens the Middle East's EV market door to NIO. Overall, NIO's qualitative assessment reveals the company as a risky bet, just like how Tesla once was, with limited fundamental strengths to support it now. Just like old Tesla, there are good plans and targets that if they pan out, the company will be in a much better position. Like Tesla, it has a strong brand and a cool swappable battery technology too. But it doesn't have the same first mover advantage that Tesla had and has to compete with 16 other EV makers such as Tesla and BYD in its core China market and European EV makers in its new markets. It's an investment bet that can win you a significant return, especially at only 2.5 times price to sales valuation ratio. But you have to accept the significant financial risk if the new vehicle lineup doesn't sell as fast or the company doesn't reach its profit margins that it has on its plan. If you have your eyes on it, remember that the next quarterly earnings report is expected to come out in August. You can get the date by clicking on the key date section of the company's stock card. When the earnings come out, watch for a few things. Early in the year, the company's leadership announced it could reach profitability by the end of 2023, thanks to the launch of several new models in the first half of the year. So you'd want to review the company's second quarterly performance and see what the management think about the feasibility of reaching its sales and profitability target in 2023. Monitor the number of deliveries per month and see if it has managed to scale it up to the target of 20,000 per month. Look at gross margin trends and see if the company has managed to reach back to 15% gross margin with the launch of its new product lineup. Despite everything I discussed today, NIO's stock may still go up. There are forces in place that can push NIO's stock price up just the same as the 30% growth in the last months. For example, any positive news around deliveries and the US-China relationship can be catalysts for NIO. Also, if the Abu Dhabi government continues to invest or subsidizes the development of new manufacturing facilities in the Middle East, we will most likely see a price spike. NIO isn't the only EV bet though. There are other ways to invest in the EV market that take less risk. Let's build a stock screener together right here, right now in 30 seconds. If I go to the stock screener on a StockCard platform, type electric vehicle in the keyword filter, and then look for the companies with at least a stable revenue growth and no cash concerns, I'll get a list of 20 or so better stocks. I'll leave a link to this screener we just built together in the show notes so you can start your own EV research too. For me, I don't think NIO's risk is still justified. I could be wrong. You have to do your own research. Like and comment so I know you'd like to see more episodes like today, and see you next time.